Assalamualaikum warahmatullahi wabarakatuh. The Honorable Lecturer and Senior Dzikri Firmansyah Hakam St. Pg.Dip M.Sc Ph.D. and everyone. Before I start my presentation, I have a story first. A few weeks ago, I was scrolling TikTok and AdSense popped up for a skincare product. It was Kiehl's Microdose Anti-Aging Retinol Serum, price 1.8 million rupiahs, and there was another ads for a retinol serum from the original too. Price only 46,200 rupiahs. Both contain retinol. Both claim to make your skin smoother and younger. And here's the strange part. Even they have the different, really different price, they both are sold out. More than 300 reviews. Most market logic says product with similar function should eventually have similar prices, but in beauty market, the price far apart. How is this possible? Many people would say it's about prestige or psychology or just rich people not caring about price. But psychology alone cannot sustain a market outcome. What sustains it is market structure. I'm Niken Erdwiyana, and on this occasion, I'll describe through this phenomenon using the lens of economic and business landscape analysis, and welcome to my presentation. First, let's look at the battlefield. The Indonesian beauty industry is worth 9 billion US dollar or over 150 trillion rupiahs. There are more than 1,000 cosmetic firms operating here. Wardah from Paragon Corp, Something, Scarlett, Avoskin, L'Oreal, and Maybelline, etc. They are all fighting for a piece of this market. As you can see on the chart, from 2023 to 2028, this market keeps growing, especially skincare, which is projected to reach 154 trillion rupiah by 2028. This isn't a small pond, this is an ocean. Now, in this ocean, we have a strange phenomenon. Let's call it beauty paradox. In normal market, like rice for example, if you have two products of the same quality, prices will eventually converge or similar. But in beauty, no. Extreme price differences. Products are functionally similar, but both are retinol serum. At first example, can have prices that are dozens of times apart. And the core question is, how can firms sell similar products at dramatically different prices and still retain customers? Now look at this price ladder. Kiehl's is at the top entry prestige, and the original at the bottom, tier 1, affordable, accessible. They don't directly compete because consumers already see them as a different product, and no single firms hold the dominant majority market share. In economics, this market structure is called monopolistic competition. This name sounds like a paradox, monopoly and competition together, but it perfectly describes the beauty industry. Many firms, low market concentration, differentiated products, and limited pricing power. Why does this structure exist? Because the barriers to entry are unique. Production barriers are low. Anyone can make a serum. Just go to the manufacturer and it's done. Like the original, proof of that. But branding barriers are extremely high. To be able to sell 1.8 million rupiah, you need BPOM halal certification to build trust, and then you need years of reputation building, and then you need massive marketing cost for influencers and AdSense. So, Entering the market is easy, but surviving and becoming a premium brand, that's really hard. Product differentiation is a key. They are not selling retinol, they are selling active ingredients, halal and BPOM certification, brand identity, packaging, influencer marketing, and as a result, consumers don't view product as a perfect substitutes, allowing firms to maintain demand even after moderate price increases. Now let's get into the economic core. The rule for profit maximization is simple. Marginal revenue is equal to marginal cost. It's produced until the point where MR equal to MC. But because the demand curve in monopolistic market slopes downward, the result is price is higher than marginal cost. There is a markup. Look at the difference with perfect competition. Here, monopolistic competition as excess capacity exists, price is above marginal cost and there is a markup. But perfect competition, no excess capacity, price equals marginal cost, price equal marginal cost, and no markup. This is important. Kills intentionally doesn't produce at maximum capacity to maintain exclusivity. That's what we call excess capacity. In the short run, Kills can make large profit. In the graph, the profit is the rectangular area between price and average total cost, or ATC, and it's substantial. But because this market is free to enter, those large profits attract new entrants like the originate. As the result, in the long run, economic profit get eroded. And the point where P is equal to ATC, the firms only make normal profit, but even then P is greater than MC, and the firms continues to operate with excess capacity. They deliberately don't reach the most efficient scale. Now, this is the technical part, but it's the most important. Please look at this graph. Price elasticity of demand is measured by this formula. Percent delta in quantity divided by percent delta in price. Simply put, how sensitive are consumers when the price changes? There are two types of curves here. First, the elastic demand. The curve is flat. If the price increase a little, quantity demands drop significantly. This is the original market. If they raise their price from 46,000 to 60,000, consumers might switch to another affordable brand. Elasticity is high. Second, in elastic demand curve, the curve is steep. If the price increase, quantity demand only drop a little. This is Kills market. Their customers are loyal. If the price goes up to 2 million, for example, they might still buy. Elasticity is low. Now, the markup rule. P minus MC divided by P is equal to 1 divided by epsilon. This formula tells us that a firm's ability to set a price above its production cost depends on elasticity. If demand is elastic, epsilon is large, like the original. The markup is small. 1 divided by a large number is small, thin margin. If demand is inelastic, epsilon is small, like Kills. The markup is large. 1 divided by a small number is large, huge margin. This is why Kills can charge 1.8 million while the original charge 46,200 rupiahs, and both survive and thrive. So they don't compete on price. They compete through branding, positioning, innovation, and marketing. Beauty firms rarely engage in price wars because in this market structure, price wars are suicide. You compete on perception, not on cost. At its core, beauty companies sell differentiation, not just functional value. They craft unique experiences and identities that resonate deeply with consumers. Kiehl's isn't selling a bottle of liquid, they're selling the feeling of luxury, of clinical expertise, of heritage. The original also is selling accessibility, democratization, and the idea that good skincare shouldn't be expensive. So, what does this mean for us as students or future business leaders? First, for firms, compete on perception, not price. Build a brand that people trust, and you can command a premium. Influencer marketing isn't just hype, it's a rational strategy to shape demand elasticity. And for regulation, price dispersion is not make failure. It's natural outcomes of monopolistic competition. What we must ensure is information transparency. If Kiehl's claim anti-aging is must be provable, if the original claim B3 and retinol, it must be real. And halal certification BPOM approval becomes signal of trust, not just a stickers. And for the consumers, understand that when you buy a serum, you're not just buying retinol, you're buying into a market structure. Be critical, but also appreciate that choices exist because of this structure. Ay- Let's conclude. Indonesian beauty industry is a classic example of monopolistic competition. First, many firms, over 1,000 players from kiosk to the original, and then second, differentiated product, same ingredients, different stories. And third, contestable entry, anyone can enter but not anyone can survive. And then limited pricing power. Yes, kiosk has a power but only up to a point. Competition from new entrants keeps the market dynamic. So the next time you see a friend buying an 1.8 million serum or even yourself, remember it's not just about retinol serum, it's about market structure, elasticity, and the stories brands tell. As the next generation of business leaders, understanding this helps us see through the surface. It makes us smarter consumer and hopefully wiser for future decision making. Thank you for your attention, Mr. Dzikri and everyone. Wassalamualaikum warahmatullahi wabarakatuh.